Howdy, howdy. What is happening, folks, from the business side of things? Today, I am going to discuss what is a cash flow statement, the importance of a cash flow statement, and a cash flow statement example. The first question I want to answer for you is, what is a cash flow statement? For any type of business, cash is the biggest asset. The cash flow statement is a financial statement that summarizes the amount of cash and cash equivalents entering and leaving a company. The cash flow statement measures how well a company manages its cash position, meaning how well the company generates cash to pay its debt obligations and fund its operating expenses. It is often used in tandem with the other two key reports, the profit and loss and balance sheet statements. It is a third component of a company's financials. The next question is, why is a cash flow statement important? It's important because it informs the business owner of the business cash position at a specific date or time. For a business to be successful, it must have sufficient cash at all times. It needs cash to pay its expenses, to pay bank loans, to pay taxes, and to purchase new assets. A cash flow statement or report determines whether a business has enough cash to do exactly this. Having cash is a key requirement for a business to stay solvent. When a business no longer has enough cash to pay its dues, it's often declared bankrupt, or it's a failing business. And that's the last thing you want or I want to happen for you, the business owner. A cash flow statement is important for any business that performs work or service before collecting cash at the end. Sometimes it's 30 to 90 days or longer before receiving any revenue. Examples include an accounting company, restoration company that gets paid by insurance companies, or an IT company. Let's just use a bakery for this example. For your bakery, let's imagine you start a business with $1,000. With your $1,000, you buy a box of ingredients and bake cakes. You sell all the cakes to a customer for $5,000. The customer asks if he or she can purchase the cakes on credit, meaning the customer will pay for the cakes at the end of the month, and you agree. Let's determine your cash positions in this scenario. Under the accrual method of accounting, revenue is recognized when it's earned, not when it's received. So therefore, since you have made the sale to your customer, the sale of $5,000 must be recognized as revenue, even though you have not received the cash. You spent $1,000 on the cakes and sold them for $5,000. That leaves you with a profit of $4,000. Yay! Even though you have earned $5,000 in revenue and $4,000 in profit, you have zero cash. This scenario can play out often in the business world, which signifies the importance of producing a cash flow report. The purpose of this lesson is to describe the merits of a cash flow report and when it may be necessary. However, you will find that the majority of small businesses don't find this report necessary. As we leave today, the cash flow statement that I perform for you each week and month is part of your monthly package to help your business prosper. In addition, I will complimentary give you a cash flow statement for your own purposes. Thanks again, and look forward to speaking with you soon.